post-pandemic era, after roti, kapra and makan, insurance is the new essential to have. With the severe second wave of COVID peak in India, which we saw during the months of April and May, what we found out is the number of people between the age group of 25 and 35 buying term insurance was 30% higher than in the previous 3 months combined. This we found out from data from Policy Bazaar. Meanwhile, term insurance purchases via online insurance aggregator Insurance Dekho's website rose 70% in May compared to March. Now, according to industry insiders, inquiries about insurance plans have skyrocketed even after the infections have subsided, perhaps on a prospect of a strong third wave. It's not surprising that the sense of financial security has taken a beating across age groups due to COVID-19, but the drop is more pronounced in case of millennials. The youth appear to be displaying greater awareness of pure protection term insurance policies. Now, term insurance is essentially a type of life insurance that provides coverage for a specific period of time. This kind of life insurance provides financial protection to the nominee in case of any unfortunate event with the policy holder during the policy term. Term insurance policies provide high life cover at a low premium, sometimes as low as a few hundred rupees per month for a sum as high as 1 crore rupees. We're here to tell you the key variables to keep in mind before choosing a term insurance plan. First, let's understand who should be buying term insurance. Anyone with financial dependence should buy this policy, whether it's married couples, parents, entrepreneurs, young professionals with dependent parents, and in some cases even retirees. The 3 significant benefits of buying term insurance is life protection, tax saving and affordable premiums. Now, life insurance premiums paid are deductible from taxable income under Section 80C and hence carry a double benefit for taxpayers. One, of course, there's protection and also at the same time saving tax. The amount, which is the maturity value received under a term insurance policy, is also tax exempt subject to conditions under the Income Tax Act of 1961. Now, term insurance also has among the lowest premiums compared to different types of insurance policies. So therefore, there's the affordability angle as well. You need to do some basic homework before finalizing your term policy. First, you need to assess your needs. The sum assured of your term insurance should be adequate to meet your family's financial obligations in your absence. You also need to evaluate aspects like your age, maturity age, your financial responsibilities, your family's future financial requirements, the amount that you're willing to invest each month towards financial goals, other financial goals, of course, like your child education, etc., the loans you're already servicing today, and also account for inflation and rising costs. Now, determining the policy period comes next. You need to do that based on your age. It is often advised that the younger you are, the longer policy period would be advisable. For instance, if you have a retirement plan, then you can opt for a policy period till you reach the age of retirement to ensure that the cover extends throughout the working years and your family is financially secure in terms of a mishap. You can pay your premiums only until the age of retirement, that is, until the time you're earning your salary. But the cover extends beyond 60 years of age, so that is something you need to know. Now, look for a payout plan that works for you. You can opt for a lump sum payout or a regular monthly income payout if that's available. You should also choose the payout option as per your requirement and feasibility, as the premium also varies depending upon the payout option that you will choose. The next step is to select an insurance provider, and yes, there's a checklist for that too. Number 1 is the claim settlement ratio of the insurer, which is a great way to ascertain the company's credibility. The IRDAI announces the claim settlement ratio of insurance companies every year. This figure explains the number of claims a policy provider settles against the total number of claims that were placed in that year, giving you an insight into the credibility and the quality of the insurer. Second is the term insurance premium. This is the money you pay to the insurance company in return for financial protection. Premiums can be made in monthly, half-yearly and even annual installments. But yes, what you need to remember is that premiums tend to go up as your age also increases. Solvency ratio of the insurer tells you about its financial ability to meet customer obligations. A higher solvency ratio indicates fiscal stability, so important factor to watch out for. Instances of IRDA norm violations, market reputation like grievance ratio, etc., also something to watch out for. How long the company takes to settle its claims is another crucial factor to consider. Choose your add-ons wisely. Additional cover for death due to accident, cover for critical illness, waiver of premium on disability, and waiver of premium on critical illness. Read the fine print of all the add-ons, as they tend to be different for different companies, so you evaluate that before finalizing who your insurance provider will be. So now, how do you buy the policy once you've shortlisted the provider? You can buy it through an insurer's website or through an online aggregator where you can compare various policies as well before finalizing. With offline mode, you'll have to visit a branch, get your KYC done and fill in an application form. You can also take the agent or broker route to buy a policy. And now that you have a checklist, we urge you to go ahead, get a term insurance now to secure your loved one's future in your absence and for your peace of mind as well.